So here's the big question. You're interested in value investing and valuing and evaluating businesses on a deep level, but you don't know how, even after researching for hours, probably dozens of hours, hundreds of hours on the internet, and because nobody else shows you how to do it. This podcast has all those answers and much more about value investing and finance. My name is Jason Rivera. Welcome to Value Investing in Your Car. Hey, Jason here. In today's episode of Value Investing in Your Car, we're going to do another case study, this time of AT&T. Before I get to that, though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms, Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the Value Investing in Your Car series anywhere in the world for free. Plus, please remember to subscribe and hit the notification bell if you're watching on YouTube so you're notified every time we release a new video, and release new videos all the time. Okay, so in the last big videos like this, we've done a short analysis of a stock. We talked about Cody, stock ticker COTY, and we've also talked about ExxonMobil, stock ticker XOM. Today we're going to talk about AT&T, and I'm going to analyze this. As I do, this is the process I go through from on a visual perspective. Anytime I evaluate a stock, this is just the visual portion of things for me. So I'm going to go through this, what caught my eye visually on first look at AT&T, and frankly tell you why you should avoid it, because it's not good, which we'll get to shortly. First thing that catches my eye, if you watch the ExxonMobil video, the Cody video and the ExxonMobil video will be linked below this if you want to watch them. If you watch the ExxonMobil video, I said in that video to watch as a potential red flag if a stock has a dividend yield of anything above 7%. So this is the first thing that catches my eye, and I'll tell you why this is such a big deal. Like the ExxonMobil one going forward. I'll get back to that in a little bit. Okay, first thing, margins look fine, revenue's growing over time, dividend. So again, for context to this, go to the ExxonMobil video linked below, but their dividend is unsustainable right now. In 2019 full year, and so far this year, or in the last 12 months, it's paid more out in dividends than it's earned in net income profits. This is unsustainable because most companies, if they're healthy, and we'll talk about the unhealthiness of AT&T in a minute, but if companies are healthy, they generally pay out dividends from net income. If you have a dividend that is above 100%, eventually, or that is above earnings, you'll likely have to cut it at some point. To illustrate that, its dividend, or its earnings, were 3.42 per share in, actually they haven't cut their dividend, shockingly. That's what I was assuming these were going to show, but they do not. So that's surprising. But it's still unsustainable, and I'll tell you why here when we get to the debt section. Before I do that, anything else? So here's another reason this is unsustainable. They've issued roughly about 1.6 billion shares over the last decade to continue growing the company. Most of the time, you don't want companies to issue shares unless they're allocating that capital exceptionally well, which they may be doing in this case because their profits are high. We'll see more below. But at first glance, typically you don't want to see this, especially if it's to fund the dividend, because essentially you're giving money here as new shareholders buying AT&T stock, and they're kind of giving it back to you in a way here. So it's just moving money from one pocket to the other pocket, essentially, if you're doing this. Cash flows up. So far, pretty good up here. A couple minor things. This can be a major thing, and it is. Again, I'll tell you why. And so is this, because I've already taken a look at this. I know that these are major issues, but these are things to look for in terms of potential red flags. Okay, ROIC is okay. I look for anything above 10% on a consistent basis, so this falls below that threshold. Free cash flow to sales, higher. I look for 5% on a consistent basis, so that's fine. Low cash levels here. Compared to what looks like a pretty small amount for the size of company, when you compare its cash levels to its debt levels. This isn't super egregious, but it's also not really true, because over here, you notice the intangibles. If you watch the Cody video, again, linked below this, I explain why I don't care about intangibles for most companies and their stocks. And when I value a company, I write almost 100% of this value down, because again, most of the time these are useless goodwill and intangible assets. In AT&T's case, we'll get to its balance sheet in a second. But while these are more valuable than, say, Cody's or most companies, you still need to be super careful about a company that has this huge amount of intangibles on its balance sheet. Okay, so I said on first glance, debt levels look fine, especially the debt to equity ratio is low. I look for anything above below 1, to consider the investment. So this, on first glance, doesn't look bad. However, that's why you cannot rely just on the metrics like I just did. You need to actually go and look at the financial statements, because when you go down here, you see that AT&T has $17 billion in cash compared to $191 billion in debt. It has so much debt that is almost equal to its entire market cap. If you subtract all the debt from cash and then you subtract the market cap, there's a positive value of only about 15, 20 million off the top of my head in terms of positive equity value. That is already bad enough. But it gets even worse when you consider the intangibles, which we talked about a little bit ago. So, okay, I'm on the quarterly, I'm on the balance sheet. Okay, so let's go down here to intangibles. Huge chunk of AT&T's value is in its property, plant, equipment. Again, fine, that's to be expected because it's cell phone towers, wires, stuff like that. Okay, here's where we get to the goodwill and stuff. So trademarks, patents, I would need to go into the financial statements to figure out what exactly those are. Those may be valuable, maybe not, depending on how I deem those. These are valuable because these essentially give them rights to keep out competitors from essentially their towers or whatever the technology here is. So we need the net number. So they have almost $300 billion in tangible assets, or intangible assets, sorry. Goodwill and intangible assets that we talked about up here. And these total intangibles other than goodwill. So we need to figure out what those are by looking at the financial reports. I'm not going to do that here. Because frankly, again, just as a rule of cost or kind of a rule of thumb, mental model, whatever you want to call it, pretty much all of the time I write off 100% of this value of net intangible assets and goodwill when I evaluate the stock. Again, in this case, I would not do that because some of this holds value, but still, I would discount these enormously. I would keep maybe 100 million or 100 billion, of this $300 billion total investments. Why? Because again, intangibles and goodwill specifically, 143 billion of that, 144 billion rounded up is goodwill. Goodwill is just an accounting metric. 99% of the time, it doesn't hold any real world economic value because it's simply an accounting number. Its goodwill is the amount in excess you pay to buy another company, the amount in excess of its book value you pay to buy another company. So, for example, if they bought another company for $1 billion, or if the other company they bought had a book value of $1 billion and they bought the company for $3 billion, AT&T would record a goodwill asset on their balance sheet for $2 billion. So most of the time, this doesn't hold any real world economic sense. That's why I discount goodwill pretty much 100% of the time, or 100% of the time. This is where things get a little bit fuzzier, but still, just to be safe, I would say at most, I would put $300 billion here. Again, this may change up or down based on their financial statements and what it says in the footnotes, but I'm not going to do that here. Because if on a first glance kind of look like we're doing now, I want to go through these as fast as possible. So I can get rid of the terrible companies fast, so I can spend more time looking at the great possible investments. And I also want to be as conservative as possible here as well. So that's another reason I would use only 100 billion here. So let's say this is 200 billion in value gone off the balance sheet. That brings their equity value to the negative level. These are essentially shareholders' equity or book value. These all mean the same thing. These are the shares you buy on the market. So after debt and taking out $200 billion in value from intangibles, they have a negative equity value, which essentially means the value of their shares is worthless on the stock market. Yes, I know that's not how it works because this doesn't include operations. But as a value investor, this is what I look at first to see if there's a margin of safety. What this essentially means here is that there's absolutely zero margin of safety in this stock because of it has so much debt and there's so many intangibles. And when you have a lower margin of safety, it means the stock is riskier, and it means that you should expect to earn lower returns owning its stock going forward. I don't want any of that. I don't want part of any of that, especially with an enormous amount of debt. AT&T, and I forgot to bring it up, has so much debt. It's one of the top 10 companies in the world in terms of how much debt it has. Again, can it survive this? Probably it will, yes. Am I saying it's going to implode? Not necessarily. But for me, this makes it enormously risky, especially with all the craziness going on today. And it being one of the most indebted companies in the world makes it far too risky for me. And this also leads back. It's bringing on more debt. Actually, let's go prove this out. Let's go see if it's actually bringing on more debt the last couple of years. Let's look at the annual. Liabilities. So in 2015, it had $7 billion in short-term debt. Oh yeah, it's got a lot more debt. So in 2015, it had a total of $125 billion in debt. And as of, again, this is as of 2019. So you have to compare this to the current situation, and it has almost $200 billion in total debt. So it's upped its debt levels by $70-80 billion since 2015, in part to, of course, fund acquisitions, the 5G build out, all that kind of stuff, but also to increase the dividend. That's also why it's been issuing shares, which is these two things combined is why I said these are its dividend is unsustainable. Like with Exxon, I expect AT&T to have to cut its dividend at some point due to these factors. When that happens, it's going to drive the share price lower because many people, like I said in the Exxon video, buy these kind of quote unquote higher dividend stocks specifically for the dividend. So if they cut the dividend, it's going to drop the share price probably a decent amount for both Exxon and AT&T. And I would say that there is a high likelihood, as in probably 70-75% or better chance of both of them being forced to cut their dividend because, again, they're not earning enough from their operations to fund these dividends. They're funding these dividends, at least the growth in the dividends and a good portion of the dividend itself, with share issuances and debt. That is unhealthy. That's not the best way to allocate your capital. It's not optimal. Frankly, it's not a good thing for them to be doing, either for themselves or for you as shareholders, which again is illustrated in the huge debt load, and issuing shares is illustrated in the Cody video, where I talk about that and how I think it's driven it. If I remember memory serving me right, it's driven share issuances and debt and poor capital allocation decisions have driven that company's shares down 80% since last November. So again, this is more of a long-term thing, long-term potential issue for AT&T. I don't see this playing out in terms of massive negative issues for the stock anytime soon, but it's something to keep an eye on, especially the dividend cut combined with debt and the share issuances and all that. So I hope this helped. I hope you learned something. If I missed something, please let me know. If I didn't explain something well enough, please let me know. Seems like people are liking these videos, so I'm going to do more of these videos and post them on YouTube and turn them into podcasts as well. So if you have a stock that you want me to look at and evaluate for you, please let me know. Email me, message me, comment me on any of the social media platforms, and we will try to get that stock. The only stock I will not evaluate is banks. Banks and insurance companies. I know how to evaluate insurance companies, but it takes longer to do than this because you have to actually go to the financial statements, their financial reports, and I don't evaluate banks. So other than that, if you have a stock you want me to evaluate, I'd love to hear it. I'd love to evaluate it for you, and I'd love to get my thoughts on it to you. If you're watching on YouTube, make sure to like, love, share, subscribe, as I said at the beginning of this video, and hit the notification bell so you're notified every time we release a new video, and release new videos all the time. If you're listening on the podcast, like, love, share, subscribe, all that good stuff, and we'd really appreciate a review, because the more reviews, views, and listens we get on our content, the more people we can help. If you're looking to get free resources on how to evaluate stocks like I do, including my valuation templates, my valuation and profitability metric calculation templates, you can get those for free at the link below. You can also get a free copy of my book, How to Value Invest, and there's also a free guide, 7 tips to picking great stocks, in the links below this as well. If you're looking for more information on how to get guidance and how to find and evaluate great stocks faster, with my guidance, you can get information about our masterclass at the links below this as well. But until next time, thanks. Have a great day. Talk soon. Bye.